Hello, everyone. I'm Tony Aarps. I'm the Project Director for the USDOT Gulf Region Small Business Transportation Resource Center. We are one of 11 USD Department of Transportation's regional field offices throughout the country. And what we do is we assist small businesses with building capacity and seeking opportunities on procurement infrastructure projects. My region covers 4 states: Texas, Louisiana, Oklahoma, and New Mexico. What I'm going to be discussing with you today will be talking about the mystery of the credit score. And again, to many, the credit score is a mystery. This is so important for small businesses when they're trying to scale and grow their business and build capacity. There's going to be a need to access capital and to fund these financial obligations of day-to-day operations. The importance of the credit score. Improving and maintaining your credit score is extremely important for small business owners seeking loans or funding. Most people are aware of those core causes of bad credit, but lack knowledge of the techniques and small ways of improving credit. Many people with excellent credit scores are not aware of that, what impacts their credit score. The two major scoring companies in the US, FICO and VantageScore, they differ a bit in their approaches, but they agree on what counts most. How important? Of course, when you're seeking a business loan, bonding, insurance, employment, they're all going to look at your credit. There are 3 major credit bureaus: Experian, TransUnion, and Equifax. Credit information is reported to all the bureaus. Not all creditors report to all 3. It's regulated by the Federal Trade Commission. So if a credit is not adhering to the Fair Credit Reporting Act, you have a place to report any violation. The FICO score. The score ranges from 300 to 850. The score is based on several factors. The score may vary among the 3 bureaus. While the variations, all bureaus not have the same information. The dates for reporting the information at each bureau can vary. The algorithms for computing the score varies with the 3 bureaus. The weight of low impact factors that I'll discuss later may vary among the bureaus as well. The score may vary among the 3 bureaus because they are looking at the credit information or data differently when computing the score. However, all 3 are consistent in their use and weighting of high credit data. This is a pie chart of all the different data and factors that are used in impacting your credit score. I mentioned high impact. I'm going to spend more time on that, such as payments, how you pay your bills, 35%, credit utilization, 30%, credit history, 15%, available credit, 10%, and inquiries, 10%. Now, when it comes to the low impact, those that are under 30%, different bureaus may use different things in different factors. But the 2 most important things, of course, are payments and, of course, credit utilization. Payments. Payments or history of on-time payments indicate whether you'll make payments on time in the future. Your payment history is usually tracked for 24 months. Again, payments are about 35% of the score. Very, very important. It's pretty straightforward. Paying your bills on time. I'm going to spend a little time on this. Credit utilization. Credit utilization is the amount you owe lenders. Is one of the most important factors that impact your credit and makes up about 30% of the FICO score. Let's just give you an example. Let's just say you have a credit limit of $10,000 and you used $1,000. Your credit utilization will be determined by taking the credit used and divided by your credit limit, giving you a utilization of 10%. 10% is a good utilization. Utilization usually likes utilizations below 20%. This is where, this slide here you see is where if you are an authorized user on another account, Or in this example I'm giving you, or if your spouse, you're on your spouse, you and your spouse share accounts. I had a business owner once. We were in a workshop, and they could not understand why their credit score was low, because they paid their bills on time. They didn't owe a lot on their credit cards. And other than that, they just didn't understand why their score was like it was. This is a good example of some of the misunderstanding about credit utilization. For this particular business owner, they were possibly an authorized user on a spouse account. And as you see from here, let's just say the spouse had a credit limit of $40,000, but the spouse had used $29,000 of their credit limit. Okay, if you add both together, you'll see that they have a credit limit of $50,000, but they have a utilization of, they've used $30,000 of the credit available, which means that now when you're looking at this number, their utilization is 60% instead of the one spouse having 10% with only $10,000 and $1,000 used. Combined, being an authorized user in their spouse account, now you're looking at 60%. Big difference, big difference. Now you asked, is that spouse being irresponsible, not responsible with credit with that 29,000? Probably not. It could have been a situation where, let's just say they were in Home Depot and they had a remodeling job for $10,000 and they were offered 0% interest for 15 months. And if they do that, they would also get 10% off the cost of the remodel. Well, you're going to spend $10,000, the store offered to give you a $1,000 discount. Chances are you'll probably take that. But keep in mind, that is going to be credit utilized on that account, which is going to raise your utilization. Or it could be care credit. Could be care credit. Maybe some dental work was needed, and $5,000-$6,000 worth of dental work was needed, and they were going to give you a care credit account for 15 months, and you decide to take advantage of it, but your utilization was raised because of using that. That may be the reason for the $29,000. This particular business owner, they didn't have any cash issues. They could easily pay off the $29,000 and bring the utilization down. But it's just being made aware of how important credit utilization is in determining one's credit score. So again, this made the utilization 60%, and the creditors usually like to see a utilization below 20%. Inquiries in your accounts. This is one of the low impact factors that I talked about. Inquiries, they're hard inquiries, a hard pull. This occurs when you apply for a new line of credit, such as a credit card or a loan. It means that a creditor has requested to look at your entire credit file to determine how much risk you pose as a borrower. Soft inquiries, also known as soft pulls, and soft credit checks. This typically occurs when a person or company checks your credit as part of a background check. This may occur, for example, when a credit card issuer checks your credit without your permission to see if you qualify for certain credit card offers. A soft inquiry does not impact your credit score. A hard inquiry does impact your credit score. So you are very cognizant of the number of times that you apply for credit, because if you apply for credit, it's going to be a hard inquiry. Many times, another example of a soft inquiry is when an insurance company may be reviewing your file, or it could be a credit card company that's reviewing your file. They may inquire about credit information, but it's a soft inquiry. New accounts. New accounts open in a short window of time could point to credit problems. So when creditors look, and when this score is determined and they see a lot of new accounts, that's a negative, because it could indicate some problems with your credit problems. Credit history. Credit history is an indicator to lenders of how much experience you have in handling credit. That's why it's not wise to close out an account that you've had for a long time, because that's credit history. I've had individuals tell me, well, I decided to just, lower my credit debt, but I decided to close out a lot of accounts, and I always like always like wonder, did you close out any of the accounts that you have a lot of history with, or did you maybe close out one with very short period of time? In calculating the score, different bureaus calculate it differently. Some use the age of the oldest account, and 20 to 25 years is a good indicator. Some just average the age of all accounts. Available credit. Available credit relative to the amount of credit owed indicates to lenders that you manage credit responsibly and others have entrusted you with more available credit. Lenders and creditors who weigh this in calculating your credit score usually use 35,000 as a benchmark for good, as well as 50,000 as excellent. So the difference being, in the event that available credit is 80 points of your score, to get the entire 80, you would need maybe a available credit of 50,000. If you had available credit of 40,000, would probably be good, okay? And you may get, with 40,000, you may get 70 points, okay? Collections. The degree to which a collection hurts your credit is generally correlated with how high credit score is when the collection agency reports it as a debt. The higher your score, the more points you'll lose. Meaning that if your score is 800 and you have a collection, it will cost you more points than if your score was 600. So if your score was 600, a collection came in, it may cost you 30 points. If your score was 800 and a collection account came in, it may cost you 70 points, okay? So the higher your score, the more impact it has in deducting points from you or scores from you. The amount of the collection date is essentially irrelevant. It doesn't matter how much the collection is. It could be a collection account of $200 or it could be $2,000. They're all the same. A collection account is a derogatory event on your credit, again, regardless of whether or not it's paid or unpaid. And I'm going to stop here a minute and make sure it's perfectly clear. A collection account, if it's paid or unpaid, is the same. It'll hurt you just as much. What you need to do in the event that you have a collection account is to get with the collector and ask for a letter in writing that if you agree to settle the collection account, they will take it off your credit file. So if you owed a collection account, if you had a collection account of $2,000, you may try to get an agreement with the collector that if you pay them 30% of it, $600, would they accept that and also in writing remove it from your credit report or your credit file. Now, again, it must be in writing. Don't let them tell you that, okay, we'll do that, but first send us the $600 in this case, and then we'll remove it. You must have in writing that they agree that once you pay the settlement of $600, they will remove it from your credit account or credit file. Again, it must be in writing. Public record information, it pretty much speaks for itself. Bankruptcies, tax liens, and judgments. How long it will stay? Positive information can remain indefinitely. I've seen, something 15 years on my account, so that's fine if it's positive. Negative information is only 7 years from when it first was reported. Bankruptcies, Chapter 7 bankruptcies are reported for 10 years. Collection accounts, 7 days from the date of the charge-off. Credit account evaluation. This is another important thing. Creditors periodically evaluate your credit history, and one key thing they look for is to see if you have only been paying the minimum each month. You want to pay more than a minimum amount each month, and therefore you'll see a rise in your score, okay? So they do periodically look and just see how you're doing with not only the account you have with them, but other creditors. This, I know you probably can't, since this is a presentation online, you probably can't click on this, but this is a score, and you'll probably be getting copies of this presentation, but this is just a website for knowing more about credit scores. How to improve your score. One way to improve your score is to get a cosigner with good credit to add you to their account as an authorized user. Just as example, earlier I showed you where one spouse had a credit limit of 10,000 and the other had 40, but when combined, it was 50. So if you were to have a credit limit of 10,000 and someone else were to put you on a credit card, let's just say $20,000 credit card with no balance on it. Again, no balance, because you're trying to get your utilization up. When you add that 20,000 to your 10,000, it lowers your utilization. So that's another way. Pay consistently on time, always use auto pay. That way you won't forget. Back in the day when we would mail off payments, mail a check off, I can remember when I would write a check, put it in an envelope, put a stamp on it, go out to my car, put it in my glove compartment, plan on mailing it. 2 weeks later, look in my glove compartment, and there I see the envelope. So auto pay just eliminates all that. Don't frequently transfer balances on the card. That's not always good in having your score. And again, keep your utilization low. I mentioned earlier, sell a collection in writing to negotiate to delete the amount. And eliminate again the number of hard inquiries that you have on your credit file. Many of you, if you have credit cards, there's always alerts for you on your credit card accounts where it'll let you know when certain activity is happening with your account. So you want to definitely put alerts on your credit accounts. They'll tell you if maybe a certain dollar amount has been charged to your account. That's always good. In addition to that, you have the right to receive your credit report from all three of the bureaus one time a year. And that credit, that website you go to is www.annualcreditreport.com. Again, many times you'll see some similar names, but it has to be annualcreditreport.com in order to get it free. Okay, and what I like doing is I'll stagger it. I may order Experian, let's say the month of November, and then I may order TransUnion maybe in February, and I'll order another report maybe 3 months later from the other bureau. Correcting inaccuracies. This is a slide where I talk about how to go about contacting the credit bureau about correcting inaccuracy. Because there are things sometimes inaccurate on your credit report. And you can do this with a letter to the bureau explaining, contacting them, letting them know that there's something that's inaccurate on your credit report. What I wanted to mention, I didn't mention it up front earlier, was the fact that this was more of a presentation on how to manage your score, not to repair credit. There are individuals and companies that's their business, is repair credit. What I tried to do today is show you how to manage and monitor your credit score. But again, you can do this on your own if there's something that's not accurate in your report. This is a dispute letter. Just give me an example of if there's something on your account that's on your credit file that's inaccurate. This is something, in this example, TransUnion, you can send a letter to TransUnion to see about getting that removed. Again, you have to be it may not the first, you have to be patient, and you got to be tenacious with it, and just keep on maybe writing them letters and letters and letters to get something removed. I mentioned earlier, if you have a collection account and you wanted to have it removed to increase your credit score, again, it will not be removed unless you have a letter or a letter in writing, something in writing that collector has agreed to take it off your credit file. Otherwise, if you pay it, the credit bureaus will keep it on there. And that concludes this presentation on solving the mystery of the credit score. Thank you very much.